Ayodeji, thank you for joining us today. Obviously, this is a time when investors are always looking forward to interim dividend. We've seen one or two, but then in particular, Stanbic IBTC, after those disappointing numbers from the Tier 2 lender, still declaring a ₦1 dividend for investors. Just your thoughts on how things have played out so far.
Yeah, thanks. What we've been seeing in the market, we've been seeing reduced interest, and it's basically domestic market that have been driving activities in our market, and there's a limit to the capacity of what they can do. So after the earnings season, which I think closed last month. The few banks that were still expecting, we've seen some of them publish their earnings, and like you rightly said, Stanbic was disappointing, but the dividend was also, that was a boost to investors. And when we look at in terms of the characteristics of Nigerian investors, mostly they are dividend driven. So what we would expect, and what played out today is for a lot of the banking stocks, there's still investors still staying on the sidelines, and we're not seeing much interest. And what we're expecting, the top banks, especially GT Bank, there will be a major boost, because if they are able to sustain their interim dividend. For Zenith, yes, on a dividend yield perspective, still look very attractive, but investors are still very cautious to see whether there may be a bit of decline in the stock before they take position. So by and large, it's most of the stocks that gain today, likes of Honeywell, Flour, International Breweries, United Capital. These are stocks that investors are seeing greater positive prospects in the medium to long term, and they're trying to take position ahead in these stocks.
So is this also in addition to or solely based on the dividend yield of these stocks, of these companies?
Yes, I think on a dividend yield perspective, you would want to pick United Capital. They've been consistent. And for Honeywell, Flour, we've seen that they moved from a negative position to profitability. And when you look at the share price of the company compared to its book value, so investors may be pricing that into that company. So by and large, investors are still very cautious. There's a limit to what the domestic investors can do to drive activities in this market, and for us to see improvement in prices. As long as we have the foreign investors still on the sideline or with no activities at all, markets will just still be oscillating around gain today and down tomorrow.
Now, for the companies and the operating environment, obviously the economy is still in a fragile recovery, and for a sector like the fast-moving consumer goods, we've seen a number of them try to be as innovative or as creative as they can, not to pass on too much to the consumer, keep themselves or keep prices competitive, and retain market share. Well, what are your thoughts on the consumer goods in general? The shrinking consumer wallets, inflation, stagnant wage growth, and all of that, and how they plan to remain competitive and still retain market share?
Okay, thanks. It's going to be a delicate balance. They will want to. We'll see because of the goods or the products that they sell in terms of the demand is inelastic. They are able to pass on the cost to the consumers, but as we progress, there will be a limit to what the consumer can take, which based on their constrained wallets, consumer wallets. So what we would see is that in terms of profitability, we will begin to see a bit of moderation, because the cost of doing business has continued to increase, and that will be impacting on the profitability of this company. Across the fast-moving consumer goods, we look at the breweries, the competition will continue to remain very steep. But when you look at the consumer goods, the likes of Nestle, you look the likes of flour mills, Honeywell flour we spoke about it. For them, there's still a chance that they are able to push a bit of the cost to the consumer, and because of the kind of products that they sell, they will be able to weather the storm. But it's been a tough one, and as we progress, we will begin to see that impact on the cost of sales for most of the companies, which will impact on their margins. And as a result, that means less payouts for investors.
Okay, then we'll leave it there. Thank you, Ayodeji, for talking to us today. We appreciate your time on the show. Ayodeji Ebo, Head of Retail Investment at Chapel Hill Denham.